President Obama says the U.S. may be seeing the beginning of the end of the recession, but not everyone is convinced the economy's fundamental flaws have been fixed, even as more stimulus money is set to flood the system. That includes Chris Thornberg, principal at Beacon Economics, while Tim Speiss, partner at the Personal Wealth Advisors Group at Eisner, believes otherwise. Thanks to both of you for joining us. Tim, let me start with you. There seems to be a confluence of data. I mean, you look at the jobs, you look at the housing data, you look at new orders. Things are still terrible out there, but it seems like there's been a fundamental shift. Yes or no?
There has been a fundamental shift, really starting in May. May through June, July. If you look at many independent sources, this could be the National Association of Home Builders. It could be the Federal Labor Board, many different sources, also for-profit sources. All have been showing now in a back look improvements since May, both in the decline of unemployment rate. It's half of what it was in the first quarter, now down at, say, 322,000 a month, which is not good. Let's not mistake that. But it's certainly far better than where we were running in April, March, and February at 650,000 a month. Secondly, we're seeing price value of homes increasing for the first time. The median price of a new home now in this country has now gone up close to 8% in June compared to May. The second factor is the foreclosure rates. Those are actually in certain parts of the United States coming down. There's still the states of Arizona, Nevada, California that are getting hit very hard, but those too. And then the number of homes that don't go to sale because of credit issues, that's now at 10%. Of those sales that don't actually occur because the buyer doesn't have adequate credit or can't secure financing. So in the main, I think it's the unemployment rate. I think the unemployment rate, as it continues to go down, you're going to see housing gradually pick up further.
Yeah.
It's still not good. I don't want to mistake the fact. It's still not a great environment.
Yeah. I mean, Chris, you make the argument that I hear all the time. The fundamental problems haven't gotten better. So how could things possibly get better?
Yeah. I mean, look, government policy to date has put a tourniquet on the wound, but we have a long recovery time to go. I mean, take a couple things. Consumers and the savings rate. Savings rate right now are 6.5%, but half of that is due to the tax cuts that started at the beginning of the year, tax cuts that are going to go away next year. What's going to happen then? Less consumer spending. And while foreclosures are down, delinquencies are at an all-time high right now in the U.S., 60-plus day delinquencies are running about 6 to 6.5%. There's literally millions more foreclosures that have to be dealt with. Sure, there's a nascent recovery in the market, but is there enough pent-up demand to absorb 1 million foreclosed units? And the banks, they have at least $1 trillion in losses they have to write off. Right now, they can paper over because of the new accounting rules, but it's clear that we have a lot more work to do before this economy gets up and running.
But Chris, certainly you would agree, though, that where this country was in March and April and into May, it just does not bear out presently that those circumstances exist today.
I'm not arguing that for sure. No. Yeah. Sir, I agree completely. We're coming in for a bottom. The question is how long we're going to sit on this bottom. Right. And I'm hearing some voices from Wall Street that are looking for a quick recovery by the end of the year. And I think we got a year sitting here on bottom before you see any signs of substantial growth.
Okay. Well, but on the other hand, a company like D.R. Horton, one of the nation's largest home builders, is forecasting an 18% increase in bottom line, which equates to stock value increase. I mean, again, if we look at all the data coming in, I agree it's going to be a long recovery. But I do think the word recovery is now what we're seeing.
Yeah, okay, so given your basically differing, but you guys agree on some points, what are you each telling people to do? Chris, what would you tell people to do?
Well, for example, it depends on what you're looking at. How about the stock market?
I think the stock market's
shooting up too fast.
That's all I care about. I want to make money. Tell me how to make money.
Well, I tell people to sit on the sidelines right now because there's going to be lots of volatility, lots of up and down. You got to pick your bets very, very carefully. For example, if you're going to look for a house, wait. Give it a year. Give it a year and a half. There's no rush. Keep your powder dry.
Tim, what do you think?
I think everything's local. I think now's a great time to be looking for a home, depending upon where your marketplace is in the country. I think if you live in Nevada or Arizona or California, in New York for that matter, there's some great bargains that are there now. And I am not knowledgeable enough to predict when that will flip. As far as investing goes with our clients, if you're a long-term investor, if you're saving money for a need that's 5 years or more out, you should be back in the markets now. I mean, we've just come off a low at March 709, which was unprecedented.
But did you miss it if you were sitting on the sidelines? I mean, that's what I'm concerned about. Look at this enormous move that we've had since March. I'm worried the people that have been sitting on the sidelines and are just now watching the show and waking up to the fact that the market is rallying have missed it.
Melissa, that's okay. That's okay, because those could have been the same persons that didn't get in at 14,000. See, you can't look at this through your rearview mirror. Again, to answer your question, to make money now, if you're a long-term investor and you're looking to fund college, retirement,
it's not too late.
No, it's a good time to be back into the markets for a long-term investor.
No, I think you got to be really cautious.
Of course.
This could be a bull market rally. We could go back down again. There's spreads on a lot of debt out there are way too low right now, given the market risk. I have to disagree. It's a lot of risk still out there.
Okay, we got to leave it there, guys. Thank you so much for joining us. We appreciate it.